We're now looking at using the financial report assertions in an audit. There are assertions about classes of transactions and events for the period under audit, and there are 5 assertions here. The first assertion is occurrence, which is that transactions and events that have been recorded have occurred and relate to the entity. Then there's completeness. All transactions and events that should have been recorded have been recorded. Accuracy, that the amounts and other data and events are recorded accurately. Cut-off, that the transactions and events have been recorded in the right accounting period. And classification, that the transactions and events have been recorded in the proper accounts. So that's for the events for the period. Now let's look at assertions about account balances at the end of the period. First of all, there's existence, that the assets, liabilities and equity interests exist. Then there's rights and obligations, that the entity holds or controls the rights to assets and liabilities, that these are the obligations of the entity. Then completeness, all assets, liabilities and equity interests have been recorded where they should have been recorded. And completeness, all assets, completeness, valuation and allocation, that all assets and liabilities and equity interests are included at the appropriate amounts and any necessary valuation adjustments have been done. We've also got assertions about presentation and disclosure, that the occurrence and rights and obligations, first of all, that the disclosed events, transactions and other matters have occurred and do relate to the entity. With completeness, that all disclosures that should have been included have been included. With classification and understandability, that the financial information is appropriately presented, described and disclosures clearly expressed. And finally, accuracy and valuation, that financial and other information is disclosed fairly and at appropriate amounts. Now let's look at it. This is based on an accounts receivable balance. And here we're saying that existence, that the person who owed the company this money actually exists. Completeness, that there are no trade debtors that are not included in this balance. Valuation and allocation, that the company expects to receive this amount from the debtors, that any debtors that should have been written off have been, and rights and obligations, that the company has a legal right to receive the money at balance date. When we're looking at assertions, we really need to consider what assertions could actually be wrong. And that depends on the type of the balance that we're looking at. So for example, with debtors here, if the company is under some pressure, then there is a potential for debtors to be overstated because this would make the accounts look better. So the assertion that comes under pressure is existence and valuation. So that there may be some debts included in the accounts that don't actually exist at balance date, and there may be some values that are incorrectly stated, so that potentially some doubtful debts may not have been provided for, or if appropriate, written off. If we're looking at a creditor's balance, then the assertion that might come under pressure is completeness. There might be some creditors that aren't actually shown in the accounts. So you need to think about what the assertions that management are making. You also need to think about what assertions with respect to this balance could potentially go wrong, and then make sure that the audit objectives are particularly written to follow through with those assertions. When we've got the existence assertion in debtors, then we're saying that as an auditor, we're saying do these people actually exist? And what can we do to test that they exist? We could say, does this debt exist in full? And what can we do to test the value of this debt? So they're the audit objectives that the auditors will be following through, particularly on these assertions of risk.